Trevor, what's up,
One, I just appreciate being here. You know, I'm doing a lot of add value plays, and I remember a conversation I had with you, Tim, where it was like, hey, don't get caught holding the bag on a bunch of add value properties just in case one of them goes sideways. But I've been running the numbers on all of this, you know, semi-stabilized or stabilized stuff. It's like, you're not making any money the way the stuff is priced now. So do I just continue keeping my head down and make sure I'm buying obviously really good deals? But it would be nice to have some more stabilized stuff to just carry it out. But one of the things that I've held on to over the last year or so is I want to have 100% equity in my portfolio. So I'm kind of trying to figure out, does it make sense to go jump into, you know, the 50, 75, 100 unit plays, bring on equity investors? But I don't know. I'm just having a hard time making the numbers make sense to do something like that.
You know, I think that's a limitation in your own head of like, well, couldn't you just put a buyout clause in there that you can buy them out at a 15% annualized return at some point in the future? And so, I don't know of a single investor who wouldn't be happy with an annualized 15% return. And it gives you the opportunity to then, you make a bunch of money, you sold some other stuff, you want to own this building 100% yourself, long term, for you and your family. Then take the cash, you buy out those investors, you write them a check, dude, they're out, and now you own 100% of it. So just because you don't own 100% today doesn't mean you couldn't own 100% in the future.
Okay.
As far as value add versus stabilized, there's no doubt in my mind, I wish I would have bought more stabilized stuff earlier. I didn't need the value add stuff after a certain point, and I don't think you're going to need them either. After 100 doors that you have in your portfolio, dude, I would probably do a 50-50 of like, here's some value add, let me buy one value add, let me buy one stabilized. And even if you wanted to raise money, one of the things that we did, we had a deal in Savannah, Georgia, that we raised all the investor LP money here in this entity, and then it owned 2 properties. One was stabilized, 83 units, and then the other one was new construction, 82 units. This created cash flow and security from day one, but there wasn't as much upside. It's kind of neutral, right? This one created a ton of upside, but it was seen as more risky because we had the construction risk, the financing risk, right? The lease up risk, and all those things. But the stability in this one offset the risk in this one, and the upside in this one offset the marginal returns in this one. So by taking 2 deals and merging it up here, I didn't have to raise money from people and take orders of people who only wanted stable deals, who were okay with a lower pref return, but it was stable, and have to sell that. And then raise money over here of people who maybe wanted a little bit higher of a return, but had to be open to taking on this risk. I was able to raise money up here and then address it how I just did with you, of saying, hey, who wants upside? Well, we have that on this. Who wants stability? Well, we have that over here. So we have downside risk.
2 separate raises.
2 separate deals? No, but I did it in a single raise. So I was able to appeal to these people who wanted equity upside, and I was able to appeal to these people who wanted stability and security. And so I brought it into a single raise and raised all the money into this parent entity that owned 100% of this and owned 100% of this.
Got it.
So they got benefits of both, right? They offset each other. So you could potentially do that. Maybe you find a 20 unit and an 18 unit. 20 units stabilized, you're going to bump up the rents. You know, this ended up being a big upside. What do we, average rents were like $850 on Carlisle? Yeah, another $1,500 in 4 years, right? Like, wow. This ended up being a huge upside. Sure. Like, this was awesome. This actually was riskier than we thought. We lost a contractor. It was supposed to be built in 12 months. It took us 48 months to build it all out. It was like a big mess. So this didn't actually have the upside that this turned out as a way better project than having this one in there.
Sure.
Because it was stable. There was no risk.
Yeah.
All we had to do was bump rents.
In the capital waterfall, you have two separate ones?
No, it's
for
all
your
one.
Okay.
It's all in one. We just raise money up here,
Yeah.
and then all the money and all the profits and all the equity flows here, and we pay the pref out of this. Right? So I guess the point is, could you find a value add deal and a stabilized deal, close on them within a 6-month time frame, but promote them together and raise money into this parent entity and raise $1 million, right? But it owns this and this. You got the stability and you have the value add upside, and all of a sudden, instead of being all in at 70 cents on the dollar and 90 cents on the dollar, you blend it out and you're all in for 80 cents on the dollar.
Right. But the pref is still the same regardless of which, like...
They're not picking one. I only raised it up here. It's a 10% pref.
Okay. Got
And
it.
then this entity funded both of these.
Okay.
And then all profits roll back up to this one. So it's not two different offerings. It's one offering.
Okay. Got it. No, that's helpful.
It worked. I mean, it was relatively easy to raise money on something like that. Dude, I get that there's no equity upside in some of the stable stuff, but if you find something like what Jimmy has of, hey, let me go buy something that's stabilized, and by the way, it's got an extra acre of an additional parcel that's not leaned by, I'll go get a loan on this one, and then I get this extra parcel. I can go build something on that later. That's a great way of looking for those kinds of opportunities. Not only looking for lower rental rates than what market could be and looking for bumps there, but like, could I add storage in the back? Could I build something else? Could I build another 12 units, 15 units? Could I, where are the plays on that? Like on this deal, on the 20 unit that you're looking at, it might make sense to take those two single family. The one's so shitty, dude, spend 10 grand to tear it down, reparcel it potentially, and get all the approvals in place to build a 4 unit or 6 unit on there. And whether you build it or you sell it like that, it created enough value where now you can sell it for $150,000 to some developer, or 120 grand, 20,000 a door, 25 a door. Like that's very realistic for the lot value of being able to build some multifamily property. So if you're able to just get the rezoning done,
Sure.
that now knocks down, like right now that single family house that is worth $90,000 and needs $50,000 worth of work is only worth 40 grand. If you can get it rezoned, and maybe not even tear it down, dude, just get it rezoned, and then let the buyer tear it down. Let them spend the 10 grand.
Yeah.
And now you just triple the value of this vacant lot. Now that's value add in a stabilized deal.
That's good.
That's kind of stuff I'd be looking at.
Okay.
Dude, the stable stuff, you'll get better loan terms, lower interest rate. It's easier to finance. It's easier to raise capital on. A lot of the LPs, man, who invested in the heavy value add deals over the past 3 years haven't been getting their pref because the property's not stabilized. So they want to know, if I invest in your deal, am I getting a pref immediately?
Yeah.
That's going to happen from a stabilized deal. So you got to look for equity upside in other areas.